Good morning, everyone. And thank you so much for the opportunity. I must say, though, that I'm not the chairperson of the South African Reserve Bank. The governor may just take my job if that doesn't get addressed. So I am the divisional head of the Fintech unit in the SARB and the chairperson of the Intergovernmental Fintech Working Group. I'm really honored to be here today and to share some thoughts around a topic I think that's of a lot of interest to everyone, CBDCs, or Central Bank Digital Currencies, and fintech in general, and where we see the fintech landscape, and then the work that we are doing within the Intergovernmental Fintech Working Group, or the IFWG as it's more commonly known. So I think it's common cause that fintech is transforming the financial services ecosystem on multiple levels, from the way financial products and services are provided and consumed, to the development of new business models, processes, applications, and access to various solutions. We are certainly seeing a fintech revolution play out on the African continent. As regulators, we are presented with a unique opportunity to shape the policy and regulatory environment to support responsible innovation. Our role as regulators is not to choose winners and losers. We need to provide clear policy steer and enact appropriate frameworks to ensure a level playing field. One area where technology has enabled significant disruption is in payments. This is not surprising, as financial inclusion begins with access to payments as the gateway to other financial services. From a South African perspective, the adoption of a broad range of digital payment methods is increasing. According to MasterCard's new payment index for 2022, consumers in South Africa are increasingly and actively using digital payment solutions for various financial transactions in their everyday lives. The study found that while in-person purchases remain common, consumers are making purchases in increasingly diverse ways and via a range of digital purchasing channels. This can be attributed to the rise in the use of alternative financial services provided by incumbents, fintechs, and mobile network operators. Potential new forms of money, underpinned by distributed ledger technology, have also entered the payment space. This peer-to-peer decentralized network for transferring value has important implications for the financial system. New crypto assets in the form of stablecoins seek to replicate some of the salient characteristics of money as a medium of exchange and a store of value. At this point, these forms of privately issued tokens are largely issued by issuers that are not subject to an appropriate regulatory framework, as many jurisdictions, including South Africa, develop their response to stablecoins and crypto assets in general. As central banks modernize and future-proof their existing payment system, we have to ask ourselves questions about the role of public money in an increasingly digitalized payment ecosystem. Providing cash to the public is a core responsibility of central banks. Today, central banks provide public money in the form of notes and coins or through reserve and settlement accounts at the central bank. By providing the safest form of money in the form of central bank money, central banks carry out their monetary policy and financial stability objectives and continue to promote access to a safe and efficient payment system. In this context, the exploration of central bank digital currencies, or CBDCs, has become an area of focus for many central banks. From a South African Reserve Bank perspective, we have explored CBDCs through three related but separate projects. The first is through our retail CBDC study, which is still ongoing. The second is through Project Corker 2, where we explored the tokenization of securities and the use of a wholesale CBDC for settlement. And the third is in Project Dunbar, where we looked at improving cross-border payments through the use of a shared multi-CBDC platform. Turning to wholesale and retail CBDC. At a conceptual level, wholesale CBDC is not new. Commercial banks currently hold reserves with central banks and have access to settlement accounts with the central bank. As commercial banks currently have access to central bank money for wholesale interbank settlement, the monetary policy and financial stability implications for a wholesale CBDC appear more straightforward. This does not mean that wholesale CBDC does not present policy and regulatory issues. These issues were highlighted to us in Project Corker 2, and they continue to be an area of focus in our current work. From a retail CBDC perspective, the question is often asked, why CBDC? I think there are several possible benefits to the introduction of CBDCs. These include, for example, payments modernization and digitalization, the potential to reduce the cost and complexity of maintaining physical cash, the promotion of regional payment integration by collaborating to redesign cross-border payment system infrastructure, the facilitation of cross-border remittances by providing lower-cost infrastructure. However, these benefits could also be provided by other payment instruments, again prompting the question, so why CBDCs? A key takeaway from our work and the international research is that the policy implications of a retail CBDC depend on the CBDC design and the structure of the domestic financial system. Some of the important design considerations include whether a retail CBDC is interest-bearing, whether there are limits on the value of private CBDC holdings, the degree of centralization or decentralization relating to the underlying technology, choices about how information will be processed to balance privacy rights, anonymity, and the anti-money laundering concerns, the offline capability of retail CBDCs, and the decisions relating to how the CBDC is potentially distributed to the general public. CBDCs raise important policy considerations as central banks consider how to continue their role as a monetary anchor in the technological revolution. The expectation may have been for me to pronounce on whether or not the SARB intends to issue a retail or wholesale CBDC. Unfortunately, the jury is still out on both of those questions. Allow me to turn to the Intergovernmental Fintech Working Group and how we have structured ourselves in South Africa to drive collaboration and coordination across multiple public agencies to respond to fintech developments. The IFWG is a multi-regulatory forum that aims to demystify fintech, the regulatory landscape, and provide a safe space for experimentation and actively advance innovation. We do this primarily through the Innovation Hub, which was launched in April 2020, and its 3 facilitators, the Regulatory Guidance Unit, the Innovation Accelerator, and the Regulatory Sandbox. Since launching the Innovation Hub, we have received nearly 200 queries in the Regulatory Guidance Unit and over 50 applications as part of the first cohort when we launched the Regulatory Sandbox. These numbers demonstrate how vibrant and dynamic the South African fintech ecosystem is. More importantly, the Regulatory Sandbox, the Regulatory Sandbox and the Regulatory Guidance Units are examples of the creative ways in which private and public dialogue on innovation can be facilitated through unique channels to enhance access to regulators and rulemaking for fintechs, while also enabling regulators to hear divergent and new voices. In addition, the Innovation Accelerator is a space for us to drive both internally orientated and market-facing innovation initiatives. We currently have a number of initiatives under the Innovation Accelerator, looking at important topics such as crypto assets and stablecoins, next-generation financial market infrastructures, and open finance. Aristotle once said, "For the things we have to learn before we can do them, we learn by doing them." Learning through doing is at the heart of the IFWG's Regulatory Sandbox. As you may be aware, the IFWG recently published its first report on the learnings from our first phase of the regulatory sandbox. We have once again opened the regulatory sandbox and moved to an adjusted rolling-based approach, which means the regulatory sandbox remains open for the foreseeable future, subject to capacity constraints and the regulatory priorities as identified by the regulators from time to time. It is important to bear in mind that the regulatory sandbox is not innovation theatre, meaning the success of the sandbox should not be measured on the number of use cases that enter the sandbox. The purpose of the sandbox is to drive towards regulatory clarity in respect of those innovations that do not clearly fit within the existing regulatory frameworks. Through the IFWG, regulators and fintechs are journeying together to co-create an understanding of the major issues that fintech faces. In conclusion, fintech is not a passing phase, but a catalyst for change. Fintech allows us to reimagine a digital financial ecosystem with enhanced efficiencies, lowered barriers to entry, and a reduction in the costs of financial products or services. Through our work in the IFWG, we look forward to continuing our collaborative journey with the fintech community, and we stand ready to continue to support responsible innovation in the financial sector. In closing, I would like to extend my congratulations to the organizers of this prestigious event. I have no doubt that many countless hours went into putting an event of this magnitude together. To all the attendees, I hope that you enjoy the deliberations that take place over the next 2 days, and I thank you once again for the opportunity to address all of you.